Well, hey everyone, welcome to another week of Facebook Live, right? In Jeremy's Financial Fortress Facebook page. So again, if you are watching this live right now, appreciate it if you guys can click hashtag live. If you're not watching a replay, appreciate you can type hashtag replay so that I know that you're here. Again, appreciate all of you guys who has been following me since last year. Have been watching content, hopefully your portfolios are doing great. The yield curve has inverted, right? So is that a sign of bad news? Yes, it is, but we can talk about that another day if you want to. But in general, if a yield curve inverts, especially the 2 and 10 year, that is always a very bad sign. It's a good indicator to show people that a recession may be coming. Now, the concept is that the economy is getting better, and that's where asset prices, inflation, everything goes high. All prices will go high. Affordability, kicks in, where people can't afford. But it's giving mixed signals because the economy is getting better, way better. The non-farm payrolls actually is lesser than, I think it was down 40,000 different, adding 431,000 jobs instead of 470 as per consensus. But to me, that is still good news. I mean, people are still, the trend in America is, people are hiring and they're willing to pay whatever. So it's giving mixed signals, right? There's a yield curve inversion, which is actually sort of it makes sense because the economy is going to typically top. The only question is, when is it going to top before it topples down over? And that's something to think about. But regardless of that, today we're going to be talking about BARK. Before we begin, appreciate if you guys show some love, drop that smash that like button, smash that subscribe button if you haven't in the Financial Fortress YouTube, smash that heart button, right? Just to show a brother some love. And yeah, we're going to be talking about BARK. This is a company that people chose in the private group. I have not heard of this company before until this week. BARK is basically a dog-centric company, which is actually a good fit. It's a very good fit because people are appreciating pets more and more, especially in America. They treat it like family. So yeah, we're gonna just let's have a look at them, right? BARK. So off the bat, I mean, BARK is basically a what they do is they are a vertically integrated company. Yep. And they sell toys. They make their own toys. They make their own dog food. They have sort of healthcare for dogs, and it's a very streamlined company. It's very focused on dogs only, unlike their competitor Chewy. Yep. So we are actually doing what we call Face Off Friday in Discord, in Jeremy's Discord. And what we do is basically, we read into companies from scratch and just dig into the qualitatives and quantitatives. So what I found out about BARK is that not only are they vertically integrated, which is very interesting, they are running this sort of a DTC model, right? Direct to consumer model. So what they do is that they make their own products and people subscribe to their box, what they call, BARK box, or their food, right? So just I think the best overview will be looking at the website, and let's just check them out. BARK, making magic for all dogs and their people. So it's pretty cool. It's very dog centric, as they said, and just looking at the website makes me want to buy it for my dog. And it's convenience at your doorstep, right? So I hate shopping around for dog food. Well, I'm not as much as a dog fanatic, to be frank, and I'm not really fit to be a dog owner. But I would subscribe because to their food, They give it every month. The only thing about this, the only problem about this business model is that if it's toys, which is more of their bestseller in a way, it's not really consumable. So because it's not like food, right? It's not consumable in a way that the cycle is fast enough. So that's where the churn rate will increase. That means the people might cancel for 2 months, 3 months, then only come back in again. So that is the problem with this model. And when they're doing on dogs, right? So we want to make dogs as happy as they make us, because dogs are humans, better together. We got Super Chewer, we got Bark Box, that's the Bark Box. We got Super Chewer, which is the toys, Bark Bright, which is caring for dogs' health and wellness, right? Bark Eats, everything we do is fun. Careers, okay. So let's check out each and every one of their products. So we got Bark Box, which is basically exactly what they want. Dopest box double for free. So we got Spider-Man feature team, Madagascar. Bark box is, first box ships immediately. Subscribe for monthly Dog Joy, then party. Team collection every month. Our pack has your back. Over 2 million dogs served. So there's testimony. Featured in this. Okay, so this is basically Bark Box. Then we have Super Chewer. Durable chew toys, right? For those who play harder. Tasty chews, very decent, very, very good website. Very clean. Every box comes with 2 tough toys, 2 full-size bags, 2 mini chews. So this is the Super Chewer, super value, and it's only toys worth for $45, and the subscription is from $30 to $40, right? So that is something to think about. Plush wrap, nylon with rubber. It's good. I mean, the quality looks good. It looks good. I'm not sure. So for those of you that are in the US that are actually subscribing to this, you may want to take a look. Sorry, hold on. Let me just do this here. Okay, there we go. Yeah, so Bark, super durable dog toys. Everyone is a new adventure. Ski lodge, fall hike, deep space. Dogs love their super chewer boxes. Okay, our backpack. There we go. So we got super chewer. Then we have Bright. We're actually looking at each of the products, right? Toss your dog's toothbrush for Bright. 30 dental chews, 3 enzyme toothpaste. You shouldn't be the only one with dental routine. So it would be cool if they actually venture into so being vertically integrated, you can actually have a lot of options. You can do a lot of things. It'll be cool if they actually tackle into the vet space and dog healthcare, right? So we're gonna look at this. We're gonna look at their competitor Chewy, but all in all, this is Bark Bright, right? We got 1 month supply of dog dental chews, 1 month supply of triple enzymatic dog toothpaste, compliments for your vet. Better for them, easier for you. Okay, so I didn't check out this video, but bad dog breath stings in more ways than one. So again, they live up to their name, right? It's a dog-centric company. Then we have Bark Eats. Bark Eats is basically break down your nutrition, healthy, personalized meals for your dog. So I went into the sort of get started, and the reason why they're dog centric is because they want to know more about you. They want to know more about the dog owner, right? Obviously, they want to know more about the dog in terms of how busy are you, what age, how much do they weigh, what is their meal, what do they like, blah blah blah. Then they will personalize the meal plan for you, for the dog. So that's what makes them a little bit more dog centric and more personalized, right? So it's pretty cool, right? Fish and brown rice, grain-free turkey, all this cool stuff. So it's pretty cool the way it is, Bark Eats. The only thing is that it may be too niche, right? So we looked at Bark website. Let's look at Chewy website, which I did not know. I got confused of Chewy from the nutritional bars that we eat. But Chewy is one of the competitor. Now, the bad thing about Bark and this space is that it's highly congested. It's very competitive. They also compete with Freshpet through Panion. Yep. Chewy is the bigger one. Now, Chewy is more of a wide range company. Wide tackle in all areas, right? We got dogs, we got cats, we got pets, we got birds, we got fish, we got reptiles, we got horse. Horse. Okay. So they not only focus on dogs, right? Which makes their revenues bigger, right? It's an 8B revenue company. But sad to say, this type of model, they are actually loss making, right? Sad to say, right? But anyway, this is what they do. And but Chewy's business model is a little different. Chewy's business model is basically on pure commerce, right? E-commerce, they sell online mostly. They also, sell on stores, which is similar to what Bark is doing as well. They're actually selling in the shelf space, having shelf space. They sell it on Walmart, Target, but it's a different because a majority of the revenues in Bark is actually a DTC model, and Chewy is more physical. But they do have a component to do DTC, right? Chewy, but Chewy is everything, all the food. So yeah, this is their competitor. We just had a look. This is their website. Now let's take a look at their Q4, which I opened up, and we can actually just look at the numbers. So they have not, based on their accounting, the way they report, 2021 is actually 2020 when it comes to the report, and 2022 is actually 2021. But all in all, they have not reported Q4 yet, and the recent which is on May, the recent sort of the recent quarter will be on Q3, which is 9 months ended. This is the latest, by the way. So what happened is, sorry, I opened this by accident. So what happened is that their Q3, which is record revenue, 378 mil of revenue, cost of revenue is 160, gross profit is 218. So their gross profit is actually, let's open up my calculator, it's close to 56%. 57%. Yep, 50. Now, 57% is good as a gross profit, but the problem is the G&A is actually too high, because the G&A constitutes close to 57% of total revenues. Now, this is where DTC models have a problem. They are usually labor intensive, right? They focus, especially in this case, they focus a lot on G&A. The good news is that advertising marketing is, close to, I think, 20%. 61 divided by 378, 16%, right? 16, 17%. That's the good news. The bad news is obviously is labor intensive model, and they are loss making. So they founded since 2011, right? Similar, actually, is at the same time as Chewy, right? So we got I'm always comparing with competitors, right? So we got a company that is doing 8B revenues, right? And having 3% margins or negative, because Chewy is also loss making. So imagine having founded a company for 10 years and still loss making in a space that is not really that innovative. But the good news is that the market fit is actually picking up, and people will, they love their dogs more, right? They love their pets more. So that's the good news. The TAM is growing at a 6% CAGR, as they mentioned in the investor presentation. But all in all, we are looking at a company that is still loss making, and it's not really narrowing down from 2020, right? So this is the things that I'm getting from this from their income statement. So So what I'm seeing again is, let's see, we have DTC. Now, the key metrics to consider when it comes to BARC and subscription models will be the CAC cost of acquisition, which is the LTV, lifetime value. What is the churn? Yep. What is the churn rate? And how many subscribers? So we can actually jump in to, let's see, let me go. That's the press release. Oh, I opened up the press release. Sorry about that. Let me open up the queue. Yeah, there we go. So this is the MD&A. Now, the subscription shipments, which is basically how much is subscribed, the shipped figure for the latest quarter is 3.7 mil, right? Higher than 3.1 a year ago, which pulls up 9 months to be 10, close to 11 mil, right? So that's good news, right? It increased by, let's see, -8 divided by 8 is like 37%. So that's the good news. The revenues increased by 41%, right? So the average monthly shipment churn increased by 1%. So that's not really that good news, but it's only 1%. Okay. Active subscriptions increased as well. New subscriptions, however, decreased a little bit. Yep. Even quarter over quarter. CAC is at $55. Now, how did it get CAC? DTC spend, you know, the amount of media spending divided by new subscriptions, right? Or active subscriptions. There was a figure that they actually said how they calculated it. But the point is, the value per the cost to acquire per customer is actually $55, but the average order value is at $30. So that's a problem, right? Because you know the average order value is lower that they charge to clients on a subscription basis is lower than CAC. LTV CAC is at 4.7x. So the problem is it's increasing. Because CAC, they had to lower that down substantially, is higher than 1 year ago. So that's why the margins did not really expand. They have convertible notes paying interest of 8 to 10%, which is high. So we actually look at their income statement. We can actually see the income statement, which is here. We can actually see high interest rates because interest expense itself, 9 months is at 4 million, right? Which is still lower. I mean, it's lower than 2020 overall, but it's quite a substantial amount. Oh, sorry, other income. Oh, this was other income. So I don't take this into consideration, other income, probably because it's the sales of you know, it's either sales of a company that acquired or income tax benefit, which we have to see. But all in all, that would be their losses are actually expanding, right? 16 mil. So this is something to consider when it comes to this model. The reason why I brought up this company is because, you know, if you're a dog lover, if you're interested in subscription-based models, which is good, they are predictable. We can actually project what's gonna, you know, we can actually expect revenues because it's all based on, it's a quantity game. They have it's a good website, right? I mean, it's a sexy website, sexy product, vertically integrated. Chewy is not. Chewy is like the Amazon of dog food or pet food. So, but it's interesting. But when we jump into numbers, obviously we have to put our bear hat on and figure out whether or not this is a company that we want to invest in at these times right now. But bear in mind, BARC is those type of companies where, look at BARC. BARC is those type of companies where if let's say it's in a bear run, their stock price will be beaten down like crazy. But during a bull run where, you know, because that's how the stock market works. The stock market works like this, like that, like this, like that. So during that upturn, BARC is one of those companies that will go up 40 to 50%. And that's exactly what it did. Right? So from the lows, it went up to 50%. So this is something to consider when you want to trade it. This is not a company that I would buy at this time right now, but just looking at overall would be interesting in terms of whether or not you are Like people who like let me know in the chats, right? Let me know in the comments that are you subscribing to Bark, from the USA? Because this is actually quite an interesting company to be to have for your dogs, right? So this is something to consider. And let's look at the cash flows a little bit. So the cash flows is already obviously negative, operating cash flow, because they're loss making. They have a net loss of 31 mil. They add back D&A, stock-based expense, which is not high, 11 mil. Change in value. So this is the problem, right? I did look at the balance sheet. So the accounts receivable is actually a high amount. It's at 73 mil. Leaving the cash convergence to be very, is less. So that's where the cash is actually stuck in inventory. How I assess that to be high is because I relate that to the income, the revenue, and what is the net, the net profit, the operating profit it can have. So having inventory of 150 mil is actually really, really high, especially in comparison with the cash amount. Yeah. So these are things to consider when, we look at Bark. It's similar to Chewy. They also have high inventory because, they have to stock up inventory to sell as a commerce platform. But this is one of the bad news. Total current assets of 400 mil, total assets 438. But the good news, however, is that they actually have very, very little debt. Very little debt. So we are looking at accrued and other current liabilities 52, current liabilities at 110, long-term debt is 100, total liabilities 192. So it's very little long-term debt. Controllable long-term debt. Other long-term liabilities only at 5.8 mil. The bad news is the majority of the total assets is actually comprising of inventory. So if we minus inventory, which is actually we want to work out the quick ratio, we are looking at 288. Yeah, so we're looking at net, in a way, 288 mil minus off their long-term accounts payable and whatnot is doable. We're looking at net shareholders equity at 96 after inventory. Yeah. So this is, the good news is that low in debt, the bad news is the high inventory. Now, income statement, we looked at this 378, increase of 41% revenue. So it's still a growth company, right? In a way, it's still growing revenues year over year. It's still, but the problem that they have, if we were to read their story, we would basically need to trim. We would need to trim their G&A. We would need to trim, obviously advertising and marketing, which did not grow a substantial amount. Their G&A actually increased by, let's see, 123. Their G&A increased by 76%. Their revenue increased by 42%, right? So this is a problem, because if, let's say, revenues were to increase 42, for every dollar increase, for every revenue increase, if they continue this trend of increasing G&A, we won't see path to profitability by 3 years or 5 years, right? But what I want to do is that, which I haven't done with the group, I'm doing that actually later after this live, is I'm going to be looking at the CC, right? The conference call, looking at their guidance, because I heard that they're actually going to be profitable EBITDA wise by this year, right? 2022 is going to be EBITDA positive. So I'm waiting to see that. Q4 will be, based on seasonality, right? Will be one of the better quarters. So I'm also looking forward to that in terms of whether or not they can beat guidance and what is reported. So yeah, the good news is that reaching profitability is just nearly there, right? So the net loss, not considering the other income, is actually 59,378, is actually around negative 15% margins. So that is the bad news, because it's negative 15. But the good news is it's actually very achievable. If they were just to decrease 15% of G&A and DTC, increase their revenues on the same rate, we can actually see profitable maybe 2 years. But what are they doing? Because they're actually hiring more people. So what are they actually doing to, decrease this rate and just reach the profitability? Because once they reach profitability, we have a growing TAM, right? CAGR of 6% or 8% every year, overall in this space. We have a company that is very dog centric, makes sense. The website's clean, the products are clean, is vertically integrated. So if they were to actually increase more and more revenues, which is possible, it's not like a very far-fetched thing. When they reach profitability and just get more lean in their operations, things will get better, right? Things will get better. They will deserve a better PE. The only problem is in the space. What I have not really found a bigger direct competitor. The only direct competitor that I found is Chewy, that has higher up in the S curve, and has a PE of X amount, 15 or 20. So this is obviously not a tech company. So I don't think they deserve a PE of like 30. But for them to reach 15 to 20 will probably take 3 more years or 4. So when they do, though, it will deem as a value company. But the good news is that the stock price is beaten down. Their market cap, which is, let's see, BART market cap. The market cap is only 640 mil. So that's where, it's deemed as a value company in that way, right? So 640 mil is not, it's actually very small, very, very small. So that's the good news when it comes to BARC. I will start a position if I see that they are, based on their guidance and their conference calls and their marketing strategy is actually focused and getting more, confidence from the management. So yeah, this is about BARC, guys. Hopefully you guys found value out of this. We looked at their products, competitors. We looked at their income, financials. We didn't touch on valuation yet. We actually, after this session, I'll be talking about them in the Discord on their conference calls and guidance. So yeah, hopefully you guys found some value out of this. Again, smash that heart button, smash that like button if you can. Subscribe to our Financial Fortress YouTube channel, and I'll see you guys next week. Thank you.